Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 21 in our series for 2025, and today's date is Friday, July the 4th. First, I'll be talking to Jared McGrath, CEO of Smart WFM. Jared and I will examine the question of what CEOs need to do to cope in this era of constant change, like AI, and what strategies they need to manage things in these uncertain times. And I'll be talking to Rabobank economist Tuva Mivison about how China, Australia's biggest trading partner, is dealing with the tariffs, about the negotiations with the US, which he says have reached a truce, and how China is changing its economy. But first, let's talk to Jared McGrath.
Well, Jared, you talk a lot about what the modern CEO has to do. There's a whole lot of issues. What are the key issues for CEOs these days?
I think that the key issues for these days is just surviving the rate of change that's coming at CEOs. It's if you look back, 100 years ago, Leon, it was very much like you've got your financial responsibilities, you've got your people responsibilities, you've got your process, your operations. But today, the fundamentals are the same, but the rate of change is happening at such a significant pace that people are wanting instant feedback, instant response. You've got all sorts of technology coming at a million miles an hour. AI is a perfect example of that at the moment. And people are now considering things like, hey, what are the implications of these decisions on me, my family, community, society, planet? And so a CEO today has to be very well equipped with making sure that they're able to process all of this rate of change at a very different speed to what has happened previously.
So a lot of this stuff is coming very quickly, and a lot of this is very difficult to comprehend for the modern CEO.
It is indeed. And I think what it takes from a CEO is someone that very much invests in themselves and makes sure that they've got an incredible team of people around them that are also investing in themselves, and an organization that's investing in itself to make sure that it's innovating, ready to take on all of this change as it comes at them.
What about AI? That's a huge one.
AI is absolutely, again, coming fast. And I think AI, it's about getting the rhythm of AI for your particular organization, I think. And some organizations are on the cutting edge, and they need to be on the cutting edge of where AI is going. But if you're an organization that hasn't traditionally come from a technological background or that really digitally flavored way of operating, then as a CEO or as an organization, you've got to get yourself prepared for that first, because you just can't come and take the AI on without having a really good understanding of how it's going to fit into your operating rhythm and cadence.
My experience and conversations I've had with some businesses is that they struggle with AI. They kind of use it as a cheat tool to just come up with stuff very quickly, which is wrong. And for example, I've come across real estate agents who say, yeah, we just use ChatGPT to communicate. And I said, but ChatGPT doesn't actually communicate with your clients. It's not, and it's impersonal. It's a machine. And the other thing is your competitors are using ChatGPT, so it all sounds the same. So there's nothing to distinguish you. And the real estate agent says, I don't care. I'm just getting sales. And so you've got that problem as well.
You do. And I think it's the literacy that you as an organization need to have to be able to leverage that AI and leverage it effectively into your organization. And I know just from my organization's experience, like everything that we do with an AI layer, and we sort of using it for learning, we're using it for productivity, but you can't just let an AI generated layer of something go out the door without a human vetting it first. As an example, we're using an AI layer at the moment to do meetings of minutes. It does a very, very good job, but rest assured, every time you see those minutes, there is something that needs to be fixed. And if it went out without that human vetting first, your organisation could find itself quite embarrassed about some of the things that are written by the AI.
Well, the other issue too is that AI would be very good for stuff like email marketing because it does it all very quickly. But you'd need a human to actually vet it to make sure it's being sent to the right people, etc.
Absolutely.
So the use of AI means that companies need to be across it and they need to actually have people knowing how to use it and working with it.
So these days, I think there's almost like a set of competencies, Leon, that organisations really need to have to take on the AI. You need to have problem solving skills. You need to have digital literacy skills. You need to have, certain types of project management skills. You need to have a lot of the EQ, emotional intelligence type skills. And for organizations, I think a lot of them are really good at doing this and bringing these skills and competencies into their organizations, or have them already. But there's a lot of organizations, again, that are really struggling about this because they haven't necessarily been founded on this, what I would call digital muscle. So it's the organizations that are able to adapt and develop these competencies that are really going to do well from AI. And I think another interesting thing is that, there's a really big consideration in the market at the moment around, hey, we need to become skills-based organizations. We need to become skills-based organizations. But I think it's not a matter of going out to the market and going, I need 400 project management skills, for example, because, what does that really mean? It's more around the competencies that go with those groupings of skills that the organizations really need these days to be successful. So it's a very interesting paradigm. And, it sort of wraps back to that first question that you asked me around, what's a modern CEO? And I guess, a modern CEO is someone that can sort of take all of this conversation that we're having now and work out how, at the end of the day, it gets returns for its shareholders. Because let's face it, the financial pressures of running an organization are not going anywhere, and they're probably just increasing. And so it's a big challenge for a CEO today. It's not an easy job.
No, which is why there's a whole turnover. I mean, CEOs don't last more than about 5 years in each job.
And often I think too, and one of the things that really floats around the market at the moment, and it's also a bit of a passion of mine, is productivity. And I really question if we could keep CEOs in the role for longer and have longevity in those organizations, and we could really sort of sit down and take a 3-year, 5-year plan and so on, could you actually drive much more productivity into organizations that you do today? Because often what happens from my observations with CEOs is that a CEO will join an organization on a 2 or 3 year tenure to drive a certain outcome for that organization. And then the next 2 or 3 years, it's a certain outcome. And I really wonder whether this turnover of CEOs in organizations stifles productivity.
So what, people would be more productive with the longer term CEO?
I think the organizations would become more systemic in the way that they think and the way that they develop their plans. And I think that, to really drive productivity into organizations these days, I think it's a mix between the old three things of people, process, and technology. But these days, to really get productivity improvement, those areas need to be really so well integrated, working together. And I sometimes think that, if a short-term objective for a CEO is to go and drive bottom line profit or whatever it happens to be, are you losing sight of some of these longer term activities that need to take place in organizations? Because I think a lot of organizations have systems, processes, and technology that are very old and built on very old school thinking. And these are multi-year programs of improvement to get these right. And at the center of that, I think, stems the productivity improvements.
It's fascinating because these arguments, there's nothing terribly new in these arguments, because, I mean, you could actually sort of go right back to when people started bringing computers into the workplace and when the internet was a matter of tying up your phone line. And we remember those days, and organizations had to make huge adjustments back then, and they're still making adjustments now.
Yeah, and I think again, it probably comes back to the rate of change and it's people's expectation. One of the things that my organisation does is we help organisations roster people more effectively. And in the old days, the way it worked is you might have a healthcare worker and you might need a nurse on a certain shift, and you'd pick up the telephone and you'd find a replacement, and that took time to do that. Whereas today there are technology layers out there that can automate most of this, almost take the human interaction out of that equation. And I think that it's actually being able to adopt those new technologies, and those new technologies again are coming at you so fast. So I'm a worker, whether I'm, whatever age group I work in, I want to work for an organization that makes it really, really easy for me to work for them and gives them just a great experience. And I think, again, it's that rate of change that's making it harder and making it faster and making it much more quickly for organisations to innovate and adapt.
Well, the key then is just adaptability.
I think that's a big part of it. Yes, I absolutely do.
Okay. Well, Jared, it's been great talking to you, and thank you so much for your time.
I've loved the discussion, Leon. Thank you so much.
And now let's talk to Rabobank economist Tuva Mevison.
Well, Tuva, what's the situation with China's economy in light of the tariffs?
Well, today a sort of trade truce/deal has been announced. Yesterday night it was. Basically, the agreements that were made after the Geneva meeting, I think it was 1.5 weeks ago, the agreements that have been made under that framework have been signed. Basically, that should imply that the US regains access to rare earths, including rare earth magnets, as most important part of the deal and of one of the few details also that leaked out, I should say. For China, it means that that they regain access to ethan, which is necessary for the production of plastics, amongst others, but also as a sort of, let's say, fuel for specific manufacturing that can only run on ethan. So that's also very important for China. So these are the few details that have been released. Good news. It's generally interpreted indeed by markets as good news. I think that the situation between the US and China on the trade front remains fragile. So to that extent, I don't put up my hopes too high, also because indeed still many details lack. So we still need to await more information about what exactly has been agreed upon. So that regarding the trade side of things.
Indeed, but the point is the tariffs are still in place.
Yeah, the tariffs are still in place, clearly on a much lower level than during the major escalation. So to that extent, it's of course better than where we came from. And as such, indeed, I think a trade agreement is, it's often mentioned like that in the media, but I think that's overdoing it in all fairness. I don't think we can speak about a trade agreement from that perspective. I still think it would make more sense to talk about sort of a truce. I also think that that's the main aim, basically, and that this should be seen more as a sort of foundation on which future talks could be held to really work out. So as a foundation to really work out a more overarching trade agreement.
But it's as you say, it's a truce. And
yeah.
But when I first heard about it, I actually thought China was in a better bargaining position because of their access to rare earths that the US needed.
Well, I mean, they do hold a strong hand on that field, clearly, and that goes, by the way, not only for the US. I think it's important to also include the European Union in this. So from a trade perspective, of course, yesterday's truce between the US and China is having the headlines, but recently, of course, the European Union cancelled these high-level economic talks, which are always being held just before the Leaders Summit between the European Union and China, and also the European Union so cancelled this sort of annual economic meeting, this important meeting, also because of rare earths. So China is having a sort of similar position towards the European Union. I think a major reason is that rare earths are clearly have many applications, amongst others within the military, the defense industry. So it's of very much of strategic importance, also in the light of the NATO summit and EU's efforts to rearm in the coming years. They will need to have access to those rare earth metals and magnets, for that matter. So indeed, the trade tensions that China is facing are certainly not limited to the US. There's also still some dealings to do with the European Union.
But the issue too is that, I mean, how is China holding up with all these trade tensions? How's the Chinese economy traveling?
Well, there are some mixed signals here. Recently, we saw that consumption was doing much better than expected, although the reasons there are, amongst others, a shopping festival kind of thing that resulted in a spike in consumption, also government stimulus, often in the form of, let's say, sort of cash for clunkers concept, where consumers can basically hand in old cars to get a new one, for instance. And these support measures have been quite successful, but the reserved budgets for those stimulus measures have been used. So basically, I think that these stimulus packages should be maintained in order to, let's say, continue to really provide incentives for Chinese consumers to continue to consume. That's one. Second, of course, the real estate crisis is still negatively affecting consumer sentiment, willingness to consume, consumer expectations in general. So also there, we saw, and this is the more negative thing, that decline in home prices for both existing as well as newly built homes, that this decline in prices started to accelerate again after a long period of a slowing decline in prices. And this has already, of course, been going on for quite a while, the decline in housing prices. So that's still definitely suppressing consumer sentiment in China. Then we still, of course, see inward foreign direct investments in China declining sharply. That continues to decline sharply. And almost for 2 years now, it has been declining with double digits. So inward foreign direct investments is really in a sharp decline, which is, of course, not a good signal for China's economy. More recently, as of today, we saw industrial profits, of course, coming in. Year on year, we saw a drop of 9.1%, which is also quite significant. The clear reason for this were the high import tariffs during the height of the escalation of the trade spat between the US and China. So yeah, there is some positive news regarding the trade truce and some pickup in consumption, but there are definitely still some structural problems going on for China. And my expectations will be that China will be more or less forced in the near future to indeed transition its economy from a supply side export-based economy to an economy that will be more leaning on consumption. Now, of course, during the NPC in March, China's government has communicated that their main focus is on consumption, but we also know how it can go with promises made by China. They are definitely not always fulfilled, those promises. But even if they would be more serious than ever and put everything in place to continue to stimulate consumption and to increase the share of consumption for China's economic growth, it will be a gradual process that will take decades. So we should not think in years, but decades before that percentage of 43%, for instance, approaches, let's say, 60%, which is still much less than the 70% that it has in the US, the share of consumption. So yeah, this will be a long, gradual process that will also be disruptive in a way for China's economy.
Well, the issue too is that with this push towards consumption, it means that China will have to invest, put money into creating stimulus for consumers, which they've been doing. So that's going to put more drain on China's finances.
Yeah, and you can indeed also wonder to what extent this is the proper way to stimulate consumption, because, and here the real estate crisis again is very important, including also the poor performance of Chinese stock markets, of course. So this negative wealth effect where households have seen their household balances deteriorate. Yeah, sure, you can make buying for consumption cheaper. Yeah, sure. But if the value of your house is still below the volume of your mortgage, and the stock portfolio that you are holding now is still, let's say, 20% less in value than 5 years ago when you started investing, you can make borrowing for consumption very cheap. But I still don't think that this would be the optimal way to stimulate consumption, in all fairness. So I think that what China also has been doing, of course, to an extent, that increasing social security, access to healthcare, those kind of things will probably have much more effect, but clearly are far more costly. In this bill is not going to financial institutions, but directly to the government. But those measures would be far more effective, I think, in structurally increasing consumption.
But it will put a strain on Chinese government finances nonetheless.
Exactly. Yeah. Absolutely. Yeah. That's the question is indeed to what extent it would be compensated by economic growth coming from consumption, of course. But you're right. And then we indeed also have to take into account that, especially for some local governments, finances are already very fragile. Yeah, that's true.
Well, it sounds like a completely new economic model for China.
Well, we are certainly not there yet. So before we were there, I think we're talking about decades again. But yes, I think that China realizes that willingly or by force, they will have to transition, because trade tensions are not only confined anymore to the West, but you also see increasingly regional players that become wary about Chinese products following their markets. So it includes countries like the Philippines, Indonesia, India, etc., but also in Latin America, who become more wary about Chinese products flooding their markets.
Indeed. Well, Tuva, that's fascinating stuff, and thank you so much again for your time.
Thank you for your patience, and again, I'm happy that at least I've been able to facilitate you this morning. So thanks for your patience, Leon. That's really appreciated.
So what's happening in the news? Well, new estimates from the Congressional Budget Office show that Republicans' marquee domestic policy bill that made its way through the Senate would result in deeper cuts and more Americans losing health insurance coverage than the original measure that passed the House last month. According to a report, the legislation would mean 11.8 million more Americans would become uninsured by 2034. Federal spending on Medicaid, Medicare and Obamacare would be reduced by more than $1.1 trillion over that period, with more than $1 trillion of those cuts coming from Medicaid alone. The fresh estimates make official what many analysts had already predicted, and some Republican lawmakers had feared. The size and scope of the healthcare cuts in the bill, particularly from Medicaid, have been hotly debated, with fiscal hordes pressing for bigger reductions and other Republicans resisting them as they consider the impact on their constituents and health providers in their districts and states. Donald Trump's Big Beautiful Bill, which would extend Trump's 2017 tax cuts, cut Medicaid deeply, and add $3.3 trillion to US debt and increase borrowing, passed the Senate with Vice President Vance casting a tie-breaking vote after 3 Republicans broke ranks and joined the Democrats in opposition. The impact on healthcare is also at odds with President Trump's vow not to touch Medicaid except to do away with waste and fraud. Then again, Trump is a politician and politicians lie. The scale of the proposed reductions in Medicaid is unprecedented in the history of the program, which is intended to expand coverage over time since its creation in 1965. And the Bank for International Settlements, one of the world's most important financial institutions, has warned that Donald Trump's tariffs are as big a risk of higher inflation and the supply chain disruptions that drove up prices during COVID. This comes amid signs Australian businesses are already paying the price of the US President's economic plan. The Bank for International Settlements has used its closely watched annual report to argue interest rates may have to be pushed up if Trump's tariff agenda leads to an inflation outbreak. While the huge tariffs promised by the President in his Liberation Day announcement in early April have subsided, many American tariffs are due to rise sharply from July the 9th. The BIS, the central bank to the world's central banks, said the soft global economic landing hoped for at the start of the year now seemed more elusive as long-established trade relationships had begun to fray. It said economic fragmentation and protectionism would exacerbate a decades-long slowdown in economic and productivity growth, as tariffs pose a risk risk of repeating the price pressures endured by countries out of the pandemic. As the pandemic-era inflation experience made clear, disrupting supply chains could once more lead to upside surprises in inflation. Such a jolt to inflation could rekindle inflation expectations that remain sensitive after the COVID-19 related inflation experience. BIS General Manager Augustin Carson said the global economic landscape was being reshaped in part by the uncertainty and unpredictability caused by the trade disruptions unleashed by the United States. There are already signs overseas of the financial hit caused by Trump's tariff agenda. Canada's economy contracted in April as its close trade links to the US were disrupted, while data released last week revealed American GDP fell by 0.5% through the first 3 months of 2025, while the Australian economy grew through the March quarter. This predated Trump's Liberation Day announcements, but there are signs a rise in American tariffs is already starting to affect local firms. A survey by MYOB, to be released this week, shows Trump's tariffs have been felt by 17% of small and mid-sized businesses. About 41% of those surveyed said they believe the tariffs would destabilise the global economy, with more than a third expecting the impulse to both lift business costs and inflation. And shipping and logistics companies are now warning that Donald Trump's erratic tariff policies combined with low river levels are causing Europe's worst supply chain congestion since the coronavirus pandemic. The result of the tariffs: barges left waiting days to pick up goods and container ships facing long waits. The problems, worse at the ports of Rotterdam, Antwerp and Hamburg, expected to persist for at least several months. All the large hubs are overflowing, says Cesar Lucanar, Managing Director of WEC Lines, a Netherlands-based shipping company. A number of important ports across Europe were operating at their maximum capacity, Lucanar said. Albert van Ommen, Chief Executive of Netherlands-based logistics company Eurorin Group, said he thought the congestion was the worst since the pandemic, when cargo flows remained unexpectedly resilient and overwhelmed ports were struggling with staffing. The problems are the latest blow to a worldwide logistics system that had, until recently, allowed many companies to maintain minimal stock inventories, secure in the knowledge that scheduled shipping services would replenish stocks regularly to a fixed timetable. One German logistics company, Contargo, has warned customers that barges are waiting an average of 66 hours to load containers at Antwerp and 77 hours at Rotterdam. And gold is expected to become Australia's third highest value export in the next year, overtaking metallurgical coal, a key ingredient in steelmaking, according to a federal government report. The precious metals price rocketed to records in the June quarter, above US 3,400, that's 5,208 Aussie, an ounce, as investors sought haven in gold amid global share market volatility caused by conflicts in the Middle East and Ukraine and uncertainty around the Trump administration's trade war. Global central banks have also been diversifying their reserves away from US dollars and into gold, fueling demand for the metal. Australia's export earnings from gold are expected to hit $56 billion in the next year, compared with metallurgical coal exports that are likely to remain steady around $40 billion. Forecasts were contained in the federal government's Department of Industry, Science and Resources June quarterly resources and energy report. It said the outlook for the nation's overall resource and energy export earnings was for a decline of 4% for $369 billion in the year ahead. Fall in earnings has been blamed on growing global trade barriers, weak international economic growth and declining bulk commodity prices. Earnings for iron ore, which accounts for a quarter of Australia's resource and energy exports, will fall by $11 billion to $105 billion in the next 12 months. Australia is the world's largest exporter of iron ore, with annual output of 900 million tonnes, the bulk of which is bought by China. The price of iron ore, the nation's top export, recently dropped below US $100 a tonne to about US $93 after data out of China revealed a fall in its steel production. Iron ore is a key ingredient in steelmaking. The federal government report also said Australia's export earnings from liquefied natural gas would decline because of excess global supply, dropping at least $6 billion to $60 billion in the next financial year. The weaker revenues for iron ore and LNG are offsetting a rise in gold exports, according to the report. And OpenAI, the maker of ChatGPT, is urging the Albanese government to introduce tax breaks for businesses that adopt artificial intelligence, as it launched a report claiming the new technology that could make the economy $115 billion bigger. OpenAI chief economist Ronnie Chatterjee conducted a whirlwind set of meetings in Parliament House on Monday as a San Francisco-based company prepared to launch an AI blueprint for Australia, co-authored with the economic consultancy Mandala. Chatterjee met with Industry and Innovation Minister Tim Ayres, Skills Minister Andrew Giles, and Assistant Minister for Productivity Andrew Lee. On Tuesday, he met Assistant Minister for Science and Technology in the and Digital Economy, Andrew Charlton, at an AI policy forum at the University of Technology in Sydney. The meetings come just months before the Albanese government's economic reform roundtable being held from August 19 to 21st, where one of the major topics of debate will be how stringently AI should be regulated. Treasurer Jim Chalmers has backed light of touch regulation, saying the government's focus is on how the technology can boost productivity rather than establishing guardrails for its use. But unions have said they will push at the summit for the government to regulate the use of AI in the workplace. They also want to ensure that the economic